This is for Ron. Ron says, can you briefly explain the pros and cons of deep in the money bull call debit spreads? Absolutely. Okay, now, a deep in the money bull call debit spread is, of course, a parity trade to the deep out of the money high probability bull put credit. Now, we're just going to stick with the 2-week out spreads for now, Ron, because we're just going to run our weekly bull put that we already discussed about here, where we're looking for positions that are 2 weeks out in time, have an 85% probability or higher of expiring worthless. And we're still getting a good premium. Now, I'm going to take this Teledoc one, Teledoc, TDOC. This is one that Sam had talked about a little bit. One of the ones he recommends is something that's been moving a little bit more and has sort of the technical criteria he looks for. It's almost at 230. It's at 228.98. Right now, if the market was open, I could sell to open a July 24th 197 put and buy the 195 put. At midpoint, I'm getting a 48-cent net credit. And the midpoint's, this one, okay, this is 65-cent difference, so that might be a struggle to get between that. But this one's only 20 cents. I could easily buy that at 120, no problem. The midpoint between the bid and the ask of the long. And I've got an 88.6% probability. Why am I go through bull put credit spreads when Ron here is asking me about bull call debits? Let's take a look. We're going to go to our tool called the Midpoint Spread Chain. All right, 14 days out, 2.5. Okay, let me just change that real quick. Okay, what is this showing me? Over here, oh, it's not a great view, but over here on the right, Ron, this is my bull put credit spread we were just analyzing with that 48-cent net credit at the 195, 197.5, 88.6% probability, pretty high. Okay. On the left is my debit spread, and this is a 23.8% return. Okay. Over here on the left is my debit spread at the same strikes, selling the 197.5 call and buying the 195 call for a debit of $2. Which means what? If the stock's trading above 197.5, Ron, at expiration, what am I going to do? I'm going to buy shares of stock at 195, sell them at 197.5. My broker will do that for me. Sorry, you can't tell what numbers those are. That looks like chicken scratch. That's the mouse failing on me again because I'm using old batteries. But anyway, we buy at 195 to deliver at 175. We get $2.50 back. So we get a 50-cent profit on a $2 investment on the debit spread for a 25% return in that case. The whole point of this tool, the spread chain, when you link from a debit spread search or credit spread search, is that you're linked to the parity view so you can see which position gives you the best bang for the buck. Now, right away, at these strikes, at this probability, our 197.5, 195 target, I'm very tempted to go with the deep in the money bull call debit spread in this case, Ron, because it's giving me a higher 1.2% return if everything works out. What's the other portion of everything working out? I need to get the midpoints, and this is a problem. With the out-of-the-money bull put credit spread that's a parity trade that has the similar probability, Ron, you saw the bid-ask spread was maybe only 20 cents or maybe 35 cents or 60 cents. Still reasonable to target a midpoint with those numbers. What we're evaluating here is the midpoint for this position. If I was able to sell this short at 33.40, well, I've got a bid of 32.50 and an ask of 34.30. It's almost a $2 bid-ask spread. There's no guarantee I'm going to get that midpoint. I might only get 33.10, 33.20. Okay, and it's also, we've got a $2 midpoint pretty close to it here on buying the 195. There's no guarantee I'm going to get a midpoint fill at 34.50. It might be, I'm sorry, 35.40. It might be 35.80 or 35.90. Now the whole parity skew is thrown out the window because I can't get the right prices because I'm battling the bid-ask spread. That's one of the reasons that investors like to do the deep out-of-the-money bull put credit spreads as opposed to the deep in-the-money debit spreads, because when you look at it, it should be parity at midpoint. But there's less of a guarantee you're going to get the midpoint because those deeper in the money calls, whether they're 2 weeks out, whether they're a month out, whether they're 1 week out, are going to have a wider bid-ask spread, and it might get harder to fill. If I got the midpoint on this position run, I'd be much more tempted to do this one for the extra kick. But look at the next strike, the 202.5, 200, that has that 84% probability. The bull put spread at midpoint is a 17.9% return, and the debit spread is only a 13.6. If this was my target for the 84% probability with a 202.5 and the 200 strike, I'm absolutely doing the bull put credit spread to get more bang for the buck, and I wouldn't be fighting the midpoint prices. And it alternates a little bit between strikes, but that's because one of these is skewed on a midpoint price one direction or the other. Okay? Is it a reliable strategy? Well, in theory, it's as reliable as doing deep out of the money bull put credit spreads, and it has the same exact risk-reward profile. In practice, it's harder to get filled at the exact midpoint to get the best price on the deep in the money calls because of the wider bid-ask spread as you go deeper in the money to get that higher probability run. Okay? That's the main pro of the position. And a lot of investors, say, well, a good thing about this deep in the money bull call debit spread that we were looking at here, if we got the midpoints even or a little bit less, is we're in the money on the calls instead of out of the money on the puts. I could be assigned early on this 197.5 strike, and my broker would exercise the 195, and I'll have the full profit on the position way before expiration. There's no guarantee you're going to be assigned early just because you're in the money. Okay? It could happen. You're absolutely right. Whereas I'm waiting on my bull put to get expiration to expire worthless and might be holding it. But unless there's some kind of event coming up, some kind of news, in a normal market condition, you wouldn't expect to see early assignment on these positions. It can happen, you're right, but you don't expect to see it that often in that case. Okay? So, in the old days, Ron, one of the other things I would have projected on this, or I would have stated with this as a con of the debit spread, is that, remember, if I'm in my bull put, what happens? I sold that 197.5, I bought the 195, paid my commissions to enter the spread, and as long as the stock stays above 197.5 in expiration, both puts expire worthless, I keep the full credit. Whereas in the debit spread, as we're getting close to expiration, you have to make a decision. If it's still in the money, hopefully for the max profit, you leave it alone through expiration. Your broker buys shares of stock for you at 195, the call that you bought, to deliver at 197.5, the call that you sold. You get the 250 back. But your broker may have charged you 2 stock commissions, or 1 stock commission and an option commission to exercise. Those were the old days. Now, because of the great commission wars and everything along those lines, yes, there's still some fees that might come along with it, but it's all negligible. It's more tolerable in that case. But whether you got close to expiration and sold to close your call and bought to close this call for near max profit before the market closed, that required another commission. And if you took exercise and assignment, let your broker do it, then in that case you might have to pay the extra commission fees. That was a big gamble when an investor started talking about weekly options and saying, oh, why would you ever still do a monthly when the weeklies are available? I can do a great spread right here and get a 10-cent net credit on a 1-point spread. And then, yeah, in those days you had to explain to them, but yes, if you're only doing 5 contracts, that's 50 cents. And your commission fee at your broker is $15 to enter the spread, and they're going to charge you another $2 if it expires worthless, or you're going to have to pay another $15 if you close it early. So it was a $50 in for a weekly, but you're giving back $30 of it for commission, so it didn't make sense. Those were the old, that was before the first round of commissions got lowered, and everyone started charging a little bit less, around $7.95 or $8.95, and now everyone, of course, back down lower. And William, unfortunately, says this still happens in Canada, assignment and exercise fee for in-the-money debit spreads, and it sucks. Oh, I'm sorry to hear that. I mean, we still get charged for it here, too, I believe. It's not free. But again, at least the commissions are lower than they have been. So that's one of the old arguments, Ron, is why would I do a credit spread over a debit spread? And when you actually looked at it and the fees were excessive for closing it, opening it, and taking assignment and maybe paying as much as 2 stock commissions, that was a real pro of doing the credit spreads against the debit spreads because it required that extra cost to close or get full profit on through your broker. Now, thankfully, that's mitigated greatly. All right. So that's just some of those thoughts there on the debit spread versus the credit spread. And what a lot of investors intend to lean to now, Ron, by the way, is the great thing about these high probability spreads is high probability and still good double-digit return. What's the con? It comes with that 5-to-1, 6-to-1 risk-reward ratio. What a lot of investors use the debit spreads for now is speculating maybe a month out in time or maybe a little bit further, 45 days out in time. And what they're doing is sort of an out-of-the-money or at-the-money debit spread, which has a lower probability of success, which is why they're going 40 days out in time. And they're sort of straddling the stock price. What do I mean by that? Instead of a deep in-the-money debit spread, Ron, they're going to buy the at-the-money call and sell the just out-of-the-money call. Okay? So now they have a call that's not in the money, but what does this do? I'm in a 10-point spread, but look at what I did with my 10-point spread here. I'm at a 1-to-1 risk-reward ratio. Going at the money, the debit to get in is only $4.75. If this goes above 230 by August expiration, or it's above 230 at expiration, I get 10 points back. So I'm making a profit of $5.25 against an investment of $4.75. And the idea is here that, yes, you have a lower probability of success. You're only at 50%, or probably in this case at 230, I'm probably at about a 48% probability it's going to be above 230. It's probably really close to 50. But if it doesn't go up as I expect, what investors look to do is take this low debit of 475, and if their liquidation to get out of this position, i.e. the value of this long call and the buyback cost of here drops to half of the max risk, in other words about 250 or 220 or 245 or so, they'll probably close the position. But if the next spread they enter with the same type of setup goes up and wins, that 525 covered the loss from the last one and still gives them the 50% profit they expected. That's the other thing. They'll look to close these positions if they receive 50% of the max profit, and they'll close them if they see 50% of the max risk. Or they'll just leave them open and hope to get the maximum profit if it stays above 230, and then that covers maybe the next two trades if they're closing it at a 50% loss. A little bit more complicated, but this seems to be the popular approach now to the debit spreads. Going out of the money with the short call and just at or slightly in the money with the long, reverse that concept for the puts to give yourself a better 1-to-1 risk-reward ratio on the trade, and they might look to close the position if they received 50% of the profit they expected on the upside, or if they're at 50% of the max loss that was possible as well. That seems to be the popular approach with debit spreads these days, as well as the calendar spreads we discussed a little bit earlier. So Ron, those are my thoughts there, and you say very interesting. Thank you. You're welcome, Ron. I'm glad we could cover that. Sam says, thank you, sir. Very kind to be nice in the room. Enjoyed every bit of it. Keep safe. Things are not in control still. Absolutely, they're not in control here at all. I appreciate that, Sam. So good night. You take care, Sam. It's good having you here. Thank you for your comments, and thank you again for sharing some of those trades with us as well. All right. Yes, and comment here, I believe, was that William? I'm sorry, it just skipped on me again. Ron, you're welcome, so I'm glad we got to cover that for you. No, this is not William. My apologies. This is, oh, it is William. William says the one strike in, one strike out, close to what I'm doing here, debit spread also helps neutralize the theta decay. And that's absolutely correct as well in that case. All right. Real quick for Dan before we get to Mary put discussions for Edison and Debbie. Dan says, can you explain calendar credit spreads, bull and bear? Okay. Calendar credit spreads normally aren't something that I do. Some investors will try to use them as a double diagonal. They're also very hard to come by unless you've got a very wide strike difference, Dan, which gives you a very wide margin requirement. Not going to take Neo here. Let's just take something simple. Hey, Vive, why not? Vive's a good one. Hi, Vive. If I was to create a diagonal spread, what some people might call a poor man's covered call, you know I hate that term for certain reasons. I'm buying something that's 3, 4, 5 months out in time and slightly in the money. So with Viva at 254, I might buy the 230 call for December or for September, and I'm going to start selling premium month by month against it. Let me just go to the 270 in this case. Only 1 week out, so it's a low premium. Now, I have restrictions that have to be met in order to do this. The net debit has to be less than the difference in the strike prices. Instead of the stock, I'm buying an in-the-money call for a lower cost basis, similar to what William and I were talking about for a repair. And it gives me a nice profit and loss chart, potential max return based on the expected value at the long, but it did cost me $3,200. Well, I'm okay with that because I'm in a bullish position similar to a covered call structure, but it is more complicated because I don't own stock. I own a long call that has its own delta, its own implied volatility, and is going to shift with the market. It's one of the reasons why I don't like the term poor man's covered call. For me, this is a really good structure, by the way, because my debit is well below my difference in strike prices in this case. 40-point strike difference and a 32 cost, so I never go into a loss up here on the upside, which can happen with the wrong structure. Right. This is a typical diagonal calendar spread, a poor man's covered call. I have no monetary requirement in this case because the long more than covers the short. A credit calendar is, well, there's two forms of it. A credit calendar might be one in which I'm selling. Let's go to August. Okay, let's go to August in this case. And I'm going to sell that 270 call for 770. There's two ways to go about, quote unquote, a credit calendar. One way I can kind of see the benefits of, but it takes extra risk. The other way I despise. Okay, so I'm going to sell this at about 820. And I'm going to go out to September. I'm going to keep it shorter term. I know we're really close here. And I'm going to buy a 300. Okay. Now, I'm using calls, but because I sold the 270 and bought the 300, it's bearish. And I have to put up a monetary requirement. I get a credit of 285, but I have to put up the $3,000 difference in the strikes. I'm still selling near term and buying far term. It reverses when you do this. The calls become the bearish. The puts become the bullish. You're essentially doing a bear call credit spread here, but making it a calendar. On the bull puts, you'd be doing a bull put, Dan, but making it a calendar with the extra long that's a lower price than the short. Got a large, you have to cover the monetary value. The return is slightly less than the structure that I was using in this case, but not fair comparison. I'm sorry. I was using the weekly. I did this to find the better premium because I wouldn't be able to do the calendar credit on a weekly unless it was only a 1 month out or 2 month out call that's deep out of the money. Okay, so risk and obligation here, you're going to be obligated to deliver shares of stock at the 270 strike if the stock moves above that price and you're not covered till 300. Okay, so you may be forced to be short stock prior to that. Okay, the bull put would be the reverse, right? So with Viva at 254, I might be selling an August 245, let's say, put, Dan, and then buying in December, maybe 200. Something that's lower out of the money, but still gives me the lower premium to do that as well. That's all you're doing, is you're looking to do a credit, but the risk reward is just about the same. What do I mean by that? The calendar put spread that might have a similar profit and loss chart to this credit calendar probably has a debit of 2,700 and a max profit of 300. They're parity trades. You're just looking to do it as a credit, but you still have the same risk reward profile as doing an in-the-money calendar put spread. Okay? This is a parity trade. What we're looking here, this credit call calendar is a parity trade to the standard diagonal put spread that's done at a debit. That's it. That's all it is, really. Okay? Your obligations change naturally because you're using calls and you're using puts as well in that situation. Okay? All right.